Hi, everybody. This is Boris Schlossberg. Welcome to webinar number 4 of our masterclass for fundamentals and technicals. Today, the webinar is all about the commodity currencies, how to trade the Australian dollar, the New Zealand dollar, the Canadian dollar, and also a little bit about the Swiss franc as well. As always, trading foreign exchange on margin carries a high level of risk, may not be suitable for all investors, and I ask you to read the disclaimer very carefully to understand all the risks associated with trading on margin and to seek advice from an independent financial advisor if you have any doubts. So, Australian dollar, one of the most active, common, and interesting currencies to trade in the currency market, not only because it is very, very popular, but also because it has one of the highest yields in the industrialized world. Let's get to the basics about the Australian dollar. The symbol is Aussie dollar. Its nickname is just Aussie. It only has one nickname. And it is actually, surprisingly enough, the 5th most actively traded currency in the world. Even though Australia is certainly not the 5th largest economy in the world by any stretch of imagination, it is part of the G20. It's part of the 20 largest economies in the world, but nowhere near the 5th largest economies in the world. And as a matter of fact, the Australian dollar US dollar pair is the 4th most actively traded currency pair in the currency market. It's literally 5% of the total daily turnover. Now, I think one of the interesting things about this particular section or this particular webinar is to just kind of ask why the Aussie, why the Kiwi, why the Canadian dollar, why all these particular currencies, which are not extraordinarily large economies. I mean, they're far larger economies. Look, for example, India is a huge economy. China is a huge economy. Brazil is a huge economy. These are all much larger economies in many ways than these particular economies. Why do these currencies get so much activity? And when we get to the Kiwi, it's even more glaring at how small that country is relative to the amount of attention it gets in the currency market. And the basic underlying reason for it is that they're all part of the British Empire. If you sort of go back to the currency market, if you understand the full history of the currency market, you have to understand that it starts with the Great Britain pound. It starts with Britain. Britain was the gold standard of its day. It was the first empire of its day. It was the first financial superpower of its day. And the pound was the reserve currency of the world. And the Anglo-Saxon economy that Britain created and all of its satellites, and if you think about this, Australia, New Zealand, Canada are effectively satellites of UK, created this culture of currency trading. And it's the fact that the culture of currency trading has been there for years and years and years. And also because these particular economies are all Anglo-Saxon economies, just like the U.S. is an Anglo-Saxon economy. You could even make the argument that Europe is an Anglo-Saxon economy. And what I mean by that is it's not a cultural term. It's almost an economic term. What I mean by that is that every one of these economies has a high degree of openness, a high degree of transparency. The government statistics in all of these economies are transparent. There is generally very little fraud relative to the rest of the world. And because these are transparent economies, very often in parts of the world where there's not so much transparency, the amount of investor interest is far greater than the economic power of all of these nations. They do have enough power, but I think the very interesting part about why the commodity currencies are so strong as speculative instruments has much more to do with culture than it has to do with economic power. It's because you can trust their data. It's because the governments are transparent. It's because they're essentially democratic countries, and monetary policy, fiscal policy, all of those things can be speculated on without risk of fraud. And that attracts huge amount of capital far in excess of the actual economic value of these countries. And that, I think, is one of the most interesting and valuable insights when you're trying to understand why these particular currencies are so popular as speculative instruments. So, everybody clear on that? If there's any questions, feel free to ask me. I'm happy to explain that. So, Central Bank of Australia is called the Reserve Bank of Australia. It was created in 1959, although there was it was formally created in 1959, but there was actually central banking there from the beginning of the century. It's just that it was sort of codified into a Central Bank Act in 1959. And it has essentially a mandate that is more uniform than some of the other central banks. In other words, its primary mandate is essentially to control inflation. And that's why when you watch commentary from central bankers of Australia, from the governor or some of the assistant governors, they're really always focusing about whether it's low or high inflation and how they're going to target inflation. They do care about growth, but growth is a secondary component to their mandate. Their first mandate is to make sure that Australia enjoys stable inflation. By the way, sort of a throwaway fact that it certainly shocked me. I didn't realize this was true, but Australia has not had a recession I'm just curious. Type in how many years do you think Australia has not had a recession? Your biggest, wildest guess. Just type it into the box, and I'll see if anybody comes close before I tell you what has been the run of Australian growth. Anybody have any idea? Feel free to type it into the box. Tell me. 20. Chen is guessing 20 years. Saki is guessing 20 years. That's a big number, right? Certainly seems like it's an extraordinarily long run of growth. But the truth is even more bizarre or crazier than that answer. It's actually 25 years. 25 years of no recession. That's an astounding record. I mean, I was just blown away at how stable in terms of growth Australia has been in its history since really like 80s. It's just astounding. So one of the reasons, of course, people are kind of astounded. So one of the reasons, of course, why Australia has had such a strong uninterrupted sense of growth is really this. It's basically China. I mean, if you think about it, what happened in the 80s? China started to join the world. And Australia, being not only geographically very close to China, but chock full of very, very important materials that China needed essentially to build itself, became it's the wrong word to say the breadbasket, because they don't really supply food commodities, but became sort of the commodity shop for China. It became the massive supplier of commodities to China. As a result of this, it had just continuous uninterrupted growth as it went through. As you can see that it's not only the single greatest export partner in China, but it's also the single biggest import partner as well. So it basically provides raw commodities to China and then buys a lot of end market goods from China. And then, of course, the number two partner that it buys from is actually, interestingly enough, is U.S. And number three is Japan and South Korea. This actually makes perfect sense if you think about it. It's like sort of 4 of the 5 members of its partners that export to Australia are within its region, right, in Asia Pacific. And U.S. is essentially a cultural compatriot of Australia, right? So it's an Anglo-Saxon economy. It's the largest Anglo-Saxon economy, and therefore it makes a lot of sense that U.S. is going to export a lot of goods to Australia, especially because it's an English-speaking economy. So when we're talking about exports, remember, they're not just talking about goods. They're talking about a lot about services. So U.S. movies, U.S. TV shows, U.S. software, all of that counts as product that comes into Australia, which is why we're number 2 here. And conversely, it goes the other way around. Australians produce software. Australians produce a whole bunch of actors. Half the actors in America are Australian, even though you wouldn't know it because they all know how to speak American accents. But more than that, I mean, they produce a lot of good things, and it makes sense that they export within region as well. So one of the most important thing, of course, to remember is that this is the connection. I'm sorry, let me go back to this one more time. This is the key connection. Both one and one on both sides is such an intrinsically important relationship that if you follow nothing, this is the relationship you really need to follow as far as understanding what Australia is all about. So Australia is the number one exporter of iron ore, right? Which is what makes steel, which is what makes buildings, which is what makes highways, which is what makes China, right? And that is the central connection. In addition to which, surprisingly enough, there's a lot of natural gas in Australia. That's a very, very valuable commodity. Even gold, which is really sort of a non-entity commodity. It's a non-economic commodity because really who cares about gold from an economic point of view, but it does have value as a precious metal, and a little bit of beef. But literally more than a quarter of all Australian exports go to China. That is the relationship you need to understand when you're looking at Australia as a partner and as a connection to that particular part of the world. It's incredibly important, that relationship, and that relationship determines quite a lot about how we look at Australia as far as its strength or weakness. So Australia is, of course, a commodity currency, right? And therefore very intrinsically tied to commodity prices. Presently, it's trading close to around 70 cents to the U.S. dollar. What's astounding is that in the height of the China boom, the Australian dollar was actually trading more than the U.S. dollar. It was worth 110 U.S. cents. And I remember in New York City, this was maybe around 2010, 2011, when this was happening. The city was just chock full of Australians because Australians were unbelievably wealthy. They would literally, come off the planes, go enjoy New York City, buy these massive, massive suitcases, empty, fill them up, and fly back to Australia and tell everybody in New York how ridiculously cheap everything in New York was. And, remember, New York is one of the most expensive cities in America. So it just goes to show you how much wealth was generated. If you think about this, now the Australian dollar is worth 70 U.S. cents or close to maybe 73 U.S. cents. But 2 or 3 years ago, it was worth 110 cents. And that is just a massive wealth appreciation for Australians. So the basic PIP values when you're doing the Australian dollar is quite easy. Anything that ends in the U.S. dollar, and when you're doing the currency pairs, anything that ends in the U.S. dollar is simply $1 US or $10 US. It's, if it's 10,000 units, it's $1 US. If it's 100,000 units, it's $10 US. Now, everything else, all the other currency crosses, actually require you to figure out how many cents there are. What is the exchange rate, for example, of the New Zealand dollar to the US dollar? What is the exchange rate of the Japanese yen to the US dollar? What is the exchange rate, in the euro dollar? Obviously, it's going to be 71 cents Australian dollars. So when you're trying to calculate the PIP values in other currency, Aussie pairs, you have to be looking at the actual exchange value of that particular currency pair. So it's very simple. Like for example, the New Zealand dollar is worth 70 cents. So therefore, Aussie Kiwi has a 0.7 or a 0.70 or 63 cents. As of September, it was 63 cents or 6.3 dollars for 100,000 units. That's how you would calculate your PIP values. Just want to make sure that everybody understands that. When it's US dollar, it's simple. It's 1-to-1. When it's anything else, it's whatever the exchange rate of that particular, the end currency is to the US dollar. That makes sense. Is that clear to everybody? Everybody just somebody give me a yes, because I want to make sure that you guys absorb that. It's very important to understand, because it's not, if you're sort of trading 100,000 units of Aussie dollar and you make 10 pips or 100 pips, you made, let's say, $100 or $1,000. But if you traded 100,000 units of Aussie Kiwi and you made 100 pips, you only made $700 or even $630. So it's very, very important to understand there's a massive difference in PIP values. Is that clear to everybody? Somebody give me a yes in the box just to make sure that you guys understand this. Okay, great. Thank you. Okay. So when does the Australian dollar move? It's sort of very interesting. There are basically two major movement periods during the global day. And then there is this intermediate movement period that occurs, I think, essentially during the European session. So the two primary movement periods is the Asian session. So Tokyo open around 7 o'clock in the evening New York time or 2300 GMT. And then you have a whole set of releases, usually between 7:30 in the evening New York time and 12:30 a.m. New York time, which is 23:30 to about 1:30 GMT. You also have, usually around this time, between 9:30 and 1:30 New York time, Chinese data. So it's interwoven. Sometimes you actually have on the same day Australian data and Chinese data. Now, why do we include the Chinese data as a key component to understanding when the Australian dollar moves? Well, because as I showed you in the prior slide, China is such an intricate part of the Australian economy that whatever is good for China is good for Australia. Whatever is bad for China is bad for Australia. That's how the market sees it. And in fact, because this is a very interesting point, because the Chinese yuan is not a free-floating currency. It's a controlled currency by the Chinese government. It is not allowed to freely trade in the market at its own exchange rate. The only way to express pleasure or displeasure, the only way to express positive or negative sentiment towards China in a free-moving, completely unbounded market is actually through the Australian dollar. So quite often, if you have negative Chinese data and you have positive Australian data, the Aussie dollar will actually drop, not because there's something intrinsically wrong with the Australian economy at that particular point, but because the market is afraid that negative Chinese data eventually is going to have a negative impact on Australian economy, and the Australian dollar from speculative flows simply gets hit, or conversely gets bought when there's good news. So you have this first wave, essentially, of responses for the Australian dollar that happens during the Asia session, which starts at around 7 o'clock at night, which is about 2300 GMT, and goes pretty much till about 1:30 in the morning New York time, or about 5:30 GMT. So that's the Asia Open, Asia session. You get a lot of movement up and down in the Aussie. Then you have the European Open, which is what I would call the intermediate session. And generally what happens in the European Open is basically European traders who look at what happened in Europe and decide whether they want to extend the move. So let's say there's bad Australian data. The Australian data has some kind of a reaction. And the Europeans kind of decide, well, do we want to extend the move, up or down, right? And then this is the very, very interesting part. Then comes the U.S. session. And the U.S. session is completely different because U.S. session, first of all, of course, is the single most active session. We've already, I think several, webinars beforehand must have already taught you this. There is no more active time in the currency market than this particular time, 8:30 in the morning New York time, till really, you could really say 12 noon New York time. From basically New York morning to New York lunch, or if you want to look at it, New York morning to London close. This is when, it's 4 hours of the day. It's 1/6 of the day, right? It's less than 25%, maybe 20% of the day, but close to 80% of all price action happens. It's that 80-20 rule. It's the 20% of the day during which 80% of all price action happens. But what's interesting about the U.S. data and how it impacts Aussie is that the Australian dollar could trade completely differently in the U.S. session than it does in Asia session. In other words, most people kind of forget what happened as far as Australian news goes at that point, and they were really looking at the U.S. news and relative. How does U.S. news measure relative to the Aussie? And I'll explain to you some of the things that drive the Aussie relative to U.S. news. But it's very, very often that you could have U.S. news completely reverse Australian data, which is kind of interesting. So there are several, about 10 key reports. And of course, as I said to you, all of this is going to be in a PDF. You don't have to write this down. You'll be able to download all of this. But in the order of importance, the absolutely key economic metrics that the market reacts to in terms of power, in terms of magnitude. Number one, by far, is the employment data, because employment, of course, connotes everything. It connotes spending, growth, monetary policy, inflationary policy. All those things really go into employment. One of the very, very important things about, and this is true, by the way, about both the Canadian and the Australian data, they have this very interesting convention that they report what's called a headline number. And the headline number, let's say they created 50,000 jobs. And that could be, on a headline basis, it could be very good. But the true number, the number that the market really looks at is the full-time jobs versus part-time jobs. Because very often, and this is one of the things that can fool a rookie trader. Let's say the number comes out, 25,000 new jobs created. And then 5 seconds later, they say, oh, there was 10,000 full-time jobs lost and 35,000 part-time jobs created. If that's the case, it's actually bad news, because what matters to the market, and of course matters economically, is how many full-time jobs created. So you will occasionally get this kind of a disparity where the headline number could be negative, but it's actually viewed positively because the full-time jobs increased. So it's very, very important not to get fooled by the headline number. Very important to look at the difference between part-time and full-time before understanding and fully processing the news on the Australian employment data. Retail sales is the second most important component, and that's obviously spending. And that's a mover that, especially if it surprises very much, either upside to the downside, could have a big impact, because it also tends to have a big input into how the central bank is going to react. PMI data, not very market moving, but what's interesting about the PMI data that we like to look at is it tends to give us a very good clue as to how employment is going to look. So in other words, there's 3 PMIs. There is the construction, services, and manufacturing PMI. And each one of them has an employment subcomponent. And if all 3 employment subcomponents are either up or down, it gives us a pretty good clue as to whether the employment picture is going to be healthy or unhealthy on the overall number. And they all come out ahead of the employment number, so you could actually pre-forecast or forecast what kind of employment data will occur. The next and quite important component is, remember, the number one mandate of the RBA is inflation. Now, what's interesting about the way they report inflation is they have this measure called the trimmed mean inflation. That is the number that really matters, because the trimmed mean inflation is sort of like what we call pure inflation, right? It's inflation that takes away the oil and food components, which are very volatile, right? And creates a pure inflationary signal. Is there a strong inflationary signal or not? If the trim mean comes in higher than expected, that's generally viewed bullishly for Aussie, and if it comes in lower than expected, it's certainly viewed dovishly. So the important component when you're looking at the inflation data, and there's a whole bunch of it, is the trim mean release. That's the one the market really focuses on. GDP, trade, confidence, all of those things are sort of self-explanatory, and they have a modest impact, but sort of not a significant impact on trade. And then the last, but of course not the least, is 2 components. The central bank meeting itself. Now, one of the interesting things about the RBA is that this is a bank that can surprise the market. There's more than one occasion where the market thinks the bank is not going to do anything, and the bank actually acts. Or conversely, if the market is convinced that the bank is going to act and the bank doesn't do anything. In those times, when the bank really surprises the market by going opposite of what the action the market expects, you could have massive movements, 100 points, 150 points in 1 minute flat on the surprise bank announcements. In addition to which, 2 weeks after the bank announcement, they release their minutes, and that doesn't tend to be a big impact. But especially if the minutes suggest some sort of tension on the on the Bank Policy Committee, that can have some impact because it would suggest that maybe there is different policy initiatives going on going forward. So these are the key components of economic reports, from the most important to the least important. Although it's not fair to say that central bank meeting is least important. It's actually the most important one. It's just we simply put it in the end because it's one of those things that's not quantifiable. It's not a hard number. It's actually just a report. Let me know if all of this is clear to you guys, and I'll proceed. Okay, looks like everybody is pretty clear on that. So, key things to understand about Aussie. What moves the Australian dollar, right? And what are the things that you want to keep an eye on when you're trading the Australian dollar? First and foremost, really important to keep an eye on the whole commodity complex. Of course, iron ore prices are going to be the most important component, the most important sort of a price to view. But you should also see how is gold trading, how is oil trading. If either gold or oil are trading, 2, 3, 4% higher or lower, right? Even though those are not the most significant inputs to the Australian dollar is going to react. Now, on an average day when it's moving 0.5% up, 0.5% down, it's really not going to have much of an impact. But if you have a massive outsized move in commodity prices, you need to be aware of it because it's going to have an impact on the Aussie. So it's very, very important to watch that very, very carefully. Of course, the Australian dollar, even at this juncture when we only have 150 basis points in the currency, that's 1.5%, is still considered to be the highest interest rate currency in the G20 universe. And as such, it tends to be what's known as a high beta currency. Now, high beta currency is simply fancy finance speak for telling you that when the world feels good about risk, when investors feel positive about global economic growth, and they start buying up stocks all across the world. So the German DAX goes up, the Dow Jones goes up, the S&P goes up, the French CAC 40 goes up, the Australian, the ASX goes up, the Chinese stocks go up. If you have a day where the Nikkei goes up, if you have a day where sort of the global equity markets are all rising in unison, that tends to be very supportive of the Aussie because it suggests that global risk appetite is positive and people feel good about high beta currencies, and it tends to rise. Of course, it's also very sensitive to Chinese data. We talked about this a little bit earlier, but it's very important to understand that as I said, you could have a situation on any given day where you have positive Australian data, and then out comes out negative Chinese data, and the Aussie gets hit. And conversely, you could have negative Australian data, but Chinese data, like for example, Chinese GDP or Chinese industrial production comes in better than expected, especially industrial production. Because remember, industrial production is sort of the cornerstone of what Australian exports really fuel. All of those things, if they show positive uptake, very positive for the Aussie, and the Aussie tends to respond well. And then, in a similar vein, the carry trade, in case those of you who don't know what it is, and we've explained it, but I'll explain it again one more time. It's a very, very common trade in the currency market where you buy the high-yielding currency and you finance that purchase with a low-yielding currency. One, common example, and I'll discuss this pair in more detail in a little bit, is the Aussie yen. The Australian dollar has a 1.5% yield. The yen has a negative yield. So you can actually theoretically not pay any money and be able to lock in 1.5% yield on the Australian side. And so when risk appetite really runs wild, when equity prices go up and investors feel good about global demand, the carry trade really performs well, and the Aussie gets a huge benefit out of the carry trade. So when you're looking at the Australian dollar and you're trying to find out, what are some of the things that are going to move it, these, of course, are the very important correlations. Because it is a high-yield currency, yields are very, very important. Equities, if equities are rising, that's a positive risk environment. It's a positive Australian environment. Commodities, if commodities are rising, it's a positive Australian environment. and of course is a risk currency, right? So looking at the trading tips of the Australian dollar, first and foremost, it correlates with commodity prices. We talked about iron ore, but I'm also, as I said, gold and oil are very, very important components to how you want to see it, see it correlated. This is, for example, the commodity index against the Australian dollar, and you can see the very strong correlations. Sometimes one leads the other, right? So sometimes you could sort of, you could almost see how a drop in one can have even a stronger drop in the other. But generally, you have a pretty strong correlation between commodities. The Chinese yuan, one of the interesting things that I think people don't appreciate is that even though the Chinese yuan is controlled, it is not static. And as the yuan goes down, as the value of the yuan goes down, it actually impacts the Aussie. Because remember, Australians have to sell into the Chinese market. And if the value of the currency they're selling into declines, their potential for profit declines. That creates a less profitable economy, less high growth economy. Therefore, the Australian dollar suffers. So the Aussie yuan rate does have a very, very strong impact on how well it trades. You can literally see. I mean, it's sort of interesting. The decline of the Aussie is very, very correlated over the last 4 or 5 years with a decline in the yuan. The yuan has weakened considerably, and as a result, the Aussie has also weakened quite strongly. Now, this correlation over the next several years is going to be a massively important trading tip. And as a matter of fact, I think this is something everybody should be paying attention to very, very strongly over the next several years. And that's what's known as the Australian-US 2-year yield spread. So the currency market, the most important bonds, currencies are effectively micro bonds, right? Currencies are just a version of a bond that pays interest every single day, right? Every single currency is effectively a yielding instrument, right? And people don't even understand this, but actually every single currency has a yield attached to it. And as the yield goes up, the currency becomes more valuable, and that's really what drives all currency trading. So if you think about currencies as kind of these micro short-term bonds, you can get a very, very good idea fundamentally of what drives currency trading. And what specifically the market looks at is the 2-year spread, meaning that 2-year U.S. Notes and 2-year Australian bonds. How is the spread going? If the spread is increasing, meaning that the U.S. If the Australian right now, of course, the Australian has a much higher yield than the U.S. So if the Australian 2-year versus the U.S. 2-year increases its spread, then the Australian dollar will do well. And if the spread is decreasing, then the Australian dollar is going to go down. And we're now entering into probably a multi-year U.S. yield increase. What that effectively means is that the 2-year Australian-U.S. Year spread is going to decrease, meaning U.S. Rates are going to actually start to catch up with Australian rates, and in fact may actually even surpass them. And all of that is very negative for the Australian dollar. If the U.S. yields begin to really, really accelerate to the upside, then the Australian dollar, just by definition, is going to have a very, very downward path, right? The other interesting thing, and this is very much a property of Australian trade data, and I've actually, I think I can show this to you on charts. Generally, what happens is this: whenever Australian data comes out, about 10, regardless of whether it's good or bad, whatever it is, if it's super good, the price will jump very quickly, and then it will come back down. It will reverse. Conversely, if the data is super bad, the price will come back up. It tends to reverse, not by much, but it tends to reverse consistently. I think let me see if I can actually pull up. So let me just sort of show you what I have in mind. Let's go to the calendar, and I'll go back to October. I think, yeah. So October 19th, you can see, for example, everybody sees this. This is the employment change in Australia on the 19th of October. It was negative, right? It's a negative report. The market was expecting 15,000 gains, and it came in at 9.8 decline. Big shock, negative employment report, right? So let's take a look at how this traded on the charts. I'm just going to pull up my my numbers, and you can see that I'd already pulled up the 19th of October. So here's the initial reaction. Here's the initial reaction to the Australian dollar. It drops, right? It went 77.30 before the data, and it drops all the way down to around 7,700. But here's the interesting point: 5-10 minutes after the reaction of the data, what do you notice? You notice that it actually bounces back up. Now, it doesn't bounce back up by much, but it does this all the time. It does this all the time, where it's not a continuous line of negative information or positive information. It always has at least a modest correction. I shouldn't say always, but I should say most of the time. Most of the time, it has this modest correction. And that is a very tradable event that you can take advantage of. It's basically 10 minutes after the Australian data release. If it's a major release with a major surprise, you can go opposite of whatever the release is for about 10 points, and you have a very decent chance that you will succeed. This is a property, I think, both of the fact that the Australian dollar is generally not as liquid, let's say, as the euro or the pound. So the markets tend to overreact very quickly. And the dealers who control the Australian dollar at that particular point really pull their bids. You know, if the news is bad, they really just underprice it very, very quickly. And then they want to see if they can just whatever inventory they buy, they can unload onto the marketplace. So if you kind of trade with the dealers by going the opposite of what the common sense move is, you very often get a chance to make a little bit of profit. And quite often, it actually turns into a V-shaped reaction where it gets sold off and then comes right back up to its original prices, right? In this particular case, it actually extended itself all the way down. But that's a very, very interesting dynamic of how the Australian dollar trades. And of course, we have the Australian crosses here with the Euro, Aussie, Aussie Yen. Aussie Yen is that one cross, and I'll show it to you in just a few minutes. That is the big carry trade cross. That's the trade that everybody trades on a carry trade basis. We'll discuss it in just a few minutes. But now, let's change track and let's go towards the Canadian dollar, which is another very, very interesting commodity currency, and one that I think is certainly very interesting to trade for a whole bunch of reasons. The symbol for the Canadian dollar is so the question. There's one question here from Chen. He says, Australia is not an oil-producing country. Why would crude oil affect Aussie? General commodity sympathy. This is the thing. This is sort of very interesting. It doesn't make sense. It doesn't make sense logically, but because it is intrinsically tied to the whole commodity complex, and generally when the oil rises, other commodities are going to rise. The Aussie gets pulled up. It's really a speculative move rather than a logical one, but it does have a very strong correlation to it. Yeah, I mean, you're right that it doesn't have direct correlation, but it has an indirect correlation that does have an impact on price. So the one currency that is very distinctly tied to oil is the Canadian dollar. Its nickname is the loonie, 7th most actively traded currency in the world, 5th most actively traded currency pair, dollar CAD, and no surprise here, we consume, as the United States of America, 75% of all Canadian exports. It's really, really amazing. As a matter of fact, those of you who are not from North America probably won't know this fact, but 90% of all Canadians live within 100 miles of the U.S. border. To understand how astounding that is, remember that Canada, land-wise, is bigger than the United States of America. It is a bigger landmass than the United States of America, and yet 90% of all the population lives within 100 miles of the U.S. border. So it's the world's 5th largest producer of oil, very, very, very active, especially in the oil sands and with fracking and everything else. Bank of Canada is the central bank of Canada. Its mandate is pretty much price stability, very similar to Australia. You'll notice that there's quite a lot of similarity between Australia and Canada, culturally, financially, because they are the remnants of the British Empire. They've kept a lot of very British traditions in their financial sector, and they followed very, very similar rules. It was created in 1934. The central bank governor right now is Stephen Polos. And as you can see, the key details of trading here between Canada and the rest of the world, U.S. is the number one partner on both sides. But what's interesting is that China is the number two partner, right? This is very, very important. And the other interesting component here is its other neighbor all the way down south is Mexico as an important import partner, both, as an export partner and an import partner. And remember, as we're standing here right now, going forward over the next 2 to 3 years, the whole issue of trade, right now, U.S., Canada, and Mexico all enjoy what's called NAFTA, which is essentially a free trading environment between the three nations that allows almost a transparent, free flow of goods between these three massive economies. If that were to change for some reason, and there's quite a lot of political risk here over the next year or two, as how that might change. Because remember, the change in NAFTA is a change that affects not only Mexico, but affects Canada as well. It's a tripartite agreement. That could have a very, very important impact on Canadian dollar, a very negative impact, because, as I said, 75% of all exports go to America. So it's very important to keep an eye on that big thematic aspect. And if there are renegotiations of trade deals that could impact Canada negatively, could have a very long-term important impact. But for now, you're looking at the following key components, oil, cars, machinery, precious metals, electronic equipment. Those are the key things that everybody trades. And of course, it is the oil-linked currency. It's known as a petrocurrency because it is the economy. Something like 25% of all Canadian economy is one way or another linked to the oil business. So it's extraordinarily important. Its pip value is, it trades inverse dollar CAD. So it's effectively 75 US cents buys 1 Canadian dollar. And that means that 10,000 unit price gives you, each pip is worth 0.75 cents or 75 cents, right? And on 100,000, each pip is worth $7.50. And then, of course, every single other currency is based upon its currency value. So Canadian dollar is kind of interesting because it's, in many ways, it has the shortest trading span of all the currencies. It's actually quite dead in Asia, quite dead in Europe, right? Unless there's just sort of extraordinary commodity movement. If there's extraordinary commodity movement, it can move around. But generally, it only really moves during North American session, which is the 8:30 to about 12 noon New York time, when you have Canadian data, U.S. data, and very importantly, oil inventory data, which is its own little animal that can have a big impact on Canadian movement. As a matter of fact, many, many times you could have positive Canadian data but negative oil data, and the Canadian dollar will just collapse. Or conversely, negative Canadian data, everybody goes one way, and then oil prices come out, and they tend to be very positive for the oil prices, and the Canadian dollar will just soar the rest of the North American afternoon. So it's very, very important to understand. Let me just go back to this slide. I think it's really important to understand that there's really three components that I'm trying to get back to it. Three components: Canadian data, U.S. data, but this very, very important oil inventories data that can drive Canadian dollar. Now, as far as key economic reports, it's pretty clear. You have the employment report, which is exact same construct as Australia, part-time and full-time. So very important to distinguish between the two when it comes out. Quite often, this is fascinating, quite often, not always, but quite often, the employment report from Canada and the employment report from the U.S. come on the same time and the same day. And then you could have lots of very interesting divergences between how they come out. Let me just come back here. Retail sales is another interesting component that has a big impact. PMI, mild impact. Inflation prices could have a serious impact, especially if they're super low or super high, because remember, the Bank of Canada is very, very inflation sensitive. And then, of course, just like with Australia, the central bank meeting. What's interesting about the Bank of Canada is they have a central bank meeting release. So they'll say, we're raising the interest rate by 25 basis points. We're cutting the interest rate by 25 basis points. This happens at 10 o'clock New York time. Then there's an hour pause, and then they have a press conference. And this is why it's very, very important to understand this. What they say in the press conference can be quite different from what they said in their initial release, and you could have a massive turn in the Canadian dollar. So and these press conferences are all broadcast live. You can watch them if you want to. But what's important is to be incredibly aware of the fact that even when they make an interest rate announcement, that there's going to be an hour pause and a secondary wave of information that it could be interpreted completely differently from the initial wave of information. And therefore, you need to be very careful in how you trade it. So no surprise here. Number one correlation is oil, Canadian trading tip. And you can see just a very, very clear correlation with oil. I mean, when oil dropped all the way down into the 20s, the Canadian dollar was as low as 60 cents to the US dollar, almost to $1.50. And when oil was at $120 a barrel, the Canadian dollar, much like the Australian dollar, was actually above parity. It costs 110 US cents to buy one Canadian dollar. Now it only costs 75 US cents to buy Canadian dollar. Similar kind of a thing as the Australian dollar, the 2-year tracks, dollar CAD and CAD yield spread very much track each other as they do with the RBA. The other interesting quirk of the Canadian trade, whenever it's reacting to the data, is that first of all, dollar CAD does not always rise on good U.S. data. And the reason why is because the Canadian dollar, if it's good, remember, so much of the Canadian economy depends on the U.S. economy. And if the U.S. economy is doing well, the Canadian dollar actually benefits. So it's not at all unusual to see positive U.S. data, which would mean that dollar CAD should rally, actually create a decline in dollar CAD, where the Canadian dollar rallies, because the market will view that as positive Canadian dollar occasionally. It's very, very important that. The Canadian dollar also tends to rally when stocks rise. It is seen as a risk on currency. So those are very, very important points. Lastly, and this is extremely important, as I said to you, remember the Canadian employment data and the U.S. employment data tend to come out on the same day. So when they come out of the same day, you will get a knee-jerk reaction to the U.S. data first, and then 5 minutes afterwards, an adjustment the other way, perhaps, to the Canadian data. So it's very, very important to wait, let the Canadian dollar flow. The Canadian crosses, the primary Canadian crosses that everybody trades, is the Euro CAD, very active cross. It's an interesting cross to trade, and the CAD Yen, which is another one of these yield crosses. Although it's nowhere near the kind of a carry trade, because Canadian dollar doesn't have nearly as much of a yield as the Australian dollar, as the Aussie yen. But those are the two primary ones. Now, New Zealand dollar, our final commodity currency, very interesting because it's the smallest country that we trade. In fact, New Zealand is such a small country that the GDP of New Zealand, the whole country, is smaller than the GDP of the city that I'm broadcasting this from. New York City has a much larger economy than the whole New Zealand country. New Zealand, of course, is only 5 million people. So you can see that. Yet, it is the 10th most actively traded currency, 9th most actively traded currency pair, very, very active, lots of opportunity to speculate. How is this possible? It is a country so tiny that it almost seems, irrelevant, and yet so active. And it goes back to that whole Anglo-Saxon structure of the currency market. Remember, Britain started the currency market, and all of the British satellites, by culture, literally by just simply culture, were able to create massive amount of speculative interest in their currencies. And of course, because the New Zealand dollar has the highest yield of any of the industrialized nations in the world, it creates a tremendous amount of speculative interest. So it, as we say in boxing, it punches well above its weight, well above its weight. If you were to simply look at it from an economic point of view, it's a minuscule country, But from a speculative point of view, from a currency trading point of view, it's a major, major trade that a lot of people do. So Central Bank of New Zealand, Reserve Bank of New Zealand, RBNZ. What's interesting here is that RBNZ actually is the most aggressive bank of all the commodity banks. It has the widest mandate. Not only does it have a mandate to have financial stability, but it actually has a mandate for economic growth and full control of the financial system. They have far greater power as a central bank than some of the other banks. They can control how much lending other banks in New Zealand do. They can control interest rates. They can control growth. They have a much greater control of the economy than some of the other central banks do. This makes it a very, very powerful bank in a very small country. Also created in 1934. By the way, what's interesting is that, Bank of Canada, Bank of New Zealand created in 1934. The question why? This very simple answer, the Great Depression. What happened was before the Great Depression, banks were kind of unregulated. You really didn't need a coordinated monetary policy. But when the Great Depression hit all across the world, officials suddenly realized they really needed a controlled financial entity that was going to be able to control the finance sector of their economies. And many people credit the RBNZ to basically making New Zealand a modern economy through its very, very intelligent financial structure. Obviously, Australia, its partner across the Tasman Sea is its biggest export partner, but also China. Now, what's interesting about about New Zealand, and I think this is probably the better way to show this to you. If you think of Australia as hard commodities, that is iron ore, industrial, blah, 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 so on and so forth, New Zealand is all soft commodities that constantly need to be replenished. If you think about this, so there's only so many buildings, so many highways they can build in China, right? Eventually, industrial demand is going to have to taper off. But they're always going to have demand for dairy. They're always going to have demand for milk. They're always going to have demand for cheese. They're always going to have demand for meat. And China being a billion consumer economy, which is getting wealthier by the day. Remember, the critical thing, the sort of very, very important component of wealth in all of these consumer-based economies is a much greater absorption of meat and dairy as part of the diet. So one of the interesting things, and I think from a long-term point of view, it's a super bullish thing, is that New Zealand, in many ways, is far better positioned for the future Chinese growth than Australia is, and you can see that in the in the Aussie. Let me just sort of show this to you on a longer-term basis. You can really literally see this in the Australian-New Zealand cross, because let me go on that like sort of a monthly chart, because I think it's just important to see this 3 years. Actually, let me just go this. You can literally see this in the last year or so. This is a weekly chart. You can see that the Australian-New Zealand cross was at around 113, and now it's really flirting back with the critical parity. Now, it hasn't been a parity, I think, ever. And the fact, let me just see if I can go like 30 years back on this, on the monthly. Yes, it's never been at parity. But if you look at a 30-year chart on a monthly chart, you can see that it's now only 5 pennies away from parity. And that is, in fact, the currency market saying that New Zealand is much better positioned than Australia relative to China. That is, in a nutshell, the story that it's showing to the market. And I think that theme is something you should be looking at over the next couple of years as a very important theme to explore. Let me just see if there's any questions here. Nope, no questions. Okay, so we'll move on. We're going to go just a little bit over time here because I've sort of spent a lot of time, but I hope you guys don't mind. You can just hang out with me. As I said, soft commodity currency. The pip values as of September were around 63 cents. Very easy to figure out the pips. The New Zealand dollar moves very similarly to the Australian dollar. So you have this intense bit of data. The interesting thing is that New Zealand, of course, because it's time-wise, it is the start of the day. It is the world starts trading in New Zealand. If you think about how the currency market, starts, it actually starts in Auckland, New Zealand. That's the first trade of the day because they are the earliest of all. Their day starts earlier than anybody else. So New Zealand data comes out early, around between 4:45 and 6:45 p.m. New York time. And then it has an impact on Chinese data. Then, of course, we have this lull of the European session, and then we have the U.S. data. Again, U.S. data, New Zealand dollar is going to trade very much on how the U.S. data impacts the New Zealand dollar. There's less amount of data. There's really only 3 or 4 key things that the market looks at on a monthly basis. And the other interesting thing is that New Zealand doesn't release its figures every single month. They release quarterly figures, especially on the employment data. So that's why it's rarer, but it's more important. So employment, can have a big impact. Remember, this is the interesting thing about New Zealand. It's a tiny little country. So small changes could have massive movements one way or the other. As I said, the GDP of New Zealand is small in the GDP of New York. So just even a small movement in employment one way or the other could have a big impact on a percentage basis and could have a big impact on the New Zealand dollar. RBNZ meeting, of course, meets on a quarterly basis, and they move their prices, and that's a very, very important movement. And the other interesting thing that the market very much trades is because, of course, New Zealand is so heavily dependent on dairy. Dairy is primary export. Twice a month, there's a global dairy trade auction, and that auction is very important as a component of how we determine whether the New Zealand dollar is going to go up or down. So it has a correlation with the Australian dollar. But remember, and this is the interesting point, the correlation is by no means one by one. And in many ways, it's a relative strength trade at this point. And as you can see, the long-term market bet has been that New Zealand is better positioned than Australia is. And so on a longer term, if you're a longer-term trader, and you're looking out, over the next year or 2 or 3 years on the New Zealand dollar, the relative strength bet for the market could very well be parity to the Australian dollar. Here's the Aussie Kiwi. You can see the very, very strong decline of the Australian dollar. This is the Australian dollar declining against the New Zealand dollar as over time. We watch the twice-a-month dairy auctions. They usually come out during New York morning time, around 9:30, 10 o'clock in the morning, New York time, the final results. They're all printed on the webpage. It's all live, so you can see how well they're doing. And generally what you're looking for is a trend. If you have a couple of months of positive dairy increases, that's generally very, very positive for the New Zealand economy. And, of course, it is the biggest carry trade. It has the highest yield of any of the industrialized nation currencies, and therefore it is a big carry trade and a big risk on currencies. So a couple of interesting things about the New Zealand dollar. It is not, by any means, stretch imagination, a very volatile currency, right? The pound could go 200 points, but the New Zealand dollar rarely goes more than 50 points a day. But what it is a very strong trending currency. This is not a currency that tends to just be very jagged. It tends to have a pretty strong trend. If the market begins to feel either very positive or very negative about risk, it will lift the New Zealand dollar almost without retracements, in one direction or the other direction. This is a very important point. So if you're looking for big pullbacks or you're looking for any kind of change of trend movements in which to get into the trade, you may very well miss it. It's important to understand that the retracements in the New Zealand dollar tend to be much shallower than in other currencies. The trend is one of the strongest. The trend is your friend in the New Zealand dollar, so you want to stick with that position. It has a very small daily range, and when it breaks out, if it has if it's been a big consolidative move and then it tends to break out, that breakout tends to be very significant. It is one of the stronger trending currencies that we see. Amongst the crosses, the Kiwi yen, of course, a big yield currency, big carry currency, is very much in play. But also Euro Kiwi and Pound Kiwi, those tend to be very, ironically enough, very, very big moving currencies, and I'll talk to you a little bit about those just at the end of this presentation. Now, I'm going to finish just talking this presentation. We're just going to touch on the Swiss franc, which is certainly a very major currency, but has become very muted ever since the SNB pulled its peg. The Swiss franc is the ultimate risk aversion currency. Its nickname is the Swissy. It's the seventh most actively traded currency in the world. But I think what's most important about it is that it is one of the wealthiest countries on a per capita basis. It is, in fact, if you want to think about the Swiss franc, it is, in fact, the risk standard in the world. If you want to flee the risk, if you believe the world is just coming to an end, there's only one economy that has stood the test of time, whose currency has stood the test of time, that is considered to be kind of like the gold standard of the currency market, and that is the Swiss franc. So when things go terrible in the global economy, the Swiss franc tends to really perform well. And what's fascinating about this is that at this point, the Swiss National Bank has the highest negative interest rates, I think, in the history of the world as far as major currencies go. It literally costs you money to keep your money in the Swiss bank, right? But because it is viewed as such a safe haven, in other words, when things go bad, investors would rather know that the worst that can happen to them is they will lose 75 basis points if they hold their money in the Swiss franc for a year. Then they will lose 50% of US dollars or 50% of euros or 50% of Australian dollars because the world is ending. That's the kind of a dramatic bet that people make when they're thinking about the Swiss franc. It is the ultimate safe harbor in the world. And as a result of this, of course, the Swiss franc, the SNB constantly has to keep negative interest rates to avoid people plowing into the currency during any kind of a crisis. Now, the way this works, by the way, is it's not as bad as it looks, because the way the negative 75 basis points works in the real world in the Swiss banking system is that each Swiss bank is allocated a threshold by the Swiss National Bank, usually about 20 times of its reserve requirement. So only reserve balances in excess of that threshold get a negative interest rate. So you have like a whole bunch of money that each bank gets, which does not get that haircut of 75 basis points. And only when you keep more money than that bunch of money that the SNB tells you, 20%, 20 times your reserves on the books, are you penalized and have to pay 75 basis points on those reserves. That's how they're able to keep their banks still profitable, but at the same time spook the speculators from trying to plow into the currency on just a never-ending stream basis. So let me just make sure that everybody understands this, and this is pretty clear. But those are basic trading mechanics of the Swiss franc. It is the ultimate reserve currency. SNB is the national bank, of course. Price stability, they're very, very concerned about price stability. It meets 4 times out of the year. The major, Thomas Jordan is the SNB chairman. And of course, the major key Swiss data points is the rate decision, the COF leading indicator, retail sales. There's very, very little Swiss data that moves the market. The Swiss franc really moves on the following components, right? So then, we have the European time when the Swiss data is released, but it's very, very mildly market moving. And then, of course, we have the U.S. time when it's released. But it's really, really driven by a couple of things. First of all, because it can have such a wide-ranging movements in times of stress, brokers have very high margins on it. So it's extraordinarily difficult to trade it on a high margin, right? It generally, most of the time, has a very tight-ranging structure. And as a matter of fact, when the Swiss bank sees that speculators start plowing into the Swiss franc because they're starting to get afraid of how the world economy is going, they actually try to intervene and weaken the Swiss franc at that point. But generally, it moves only in times of stress. And so it will have this very, very tight range. And then if there's big stresses, then it will move on those things. So it's geopolitical events that will very often move the Swiss. And typically, of course, the native cross that is that everybody trades is actually not dollar Swiss, but it's euro Swiss. Euro Swiss is the original cross that everybody trades. Dollar Swiss is actually derived out of the Swiss trade. Oops. So the big takeaway from the Swiss franc is, if you genuinely believe that the world economy and the global situation is coming into a point of stress, then the Swiss franc becomes a very, very lucrative trade. All other times, it's actually quite the opposite. You want to be selling the Swiss franc if you believe, for example, if you believe that the next several years is going to create a sort of a renaissance in growth. It's actually going to be very, very positive to sell the Swiss franc because, first of all, it has a negative yield, so you'll be able to use it to finance those high-yielding currencies, like even the Australian dollar, the New Zealand dollar, the U.S. dollar, whatever you choose as your big growth currency. If you take the opposite view, then, of course, the Swiss franc becomes a very, very attractive trade. So the other component when you're looking at all of these commodity crosses and everything else is that you can trade the pure non-dollar trade. And what's interesting about trading the pure non-dollar trade is that you can ignore U.S. data by trading crosses that don't have a dollar component in them. So, for example, Euro Kiwi, Pound Kiwi, Aussie Kiwi, Euro Aussie, Pound Aussie. All of these crosses are stories that don't have a dollar story inside of them. They have an Australia versus Canada story, New Zealand versus Canada story, or UK versus Australia story. Those stories tend to be quite interesting. More importantly, this is what's astounding about them. Some of these crosses are the single biggest movers in the currency market day in and day out. The average daily range of the Pound Kiwi is 400 pips. Euro Kiwi, 300 pips. Euro Aussie, 300 pips. Pound Aussie, 305 pips. Pound Aussie, 300 pips. So they provide massive speculative movements because what they're basically bets on is positive news on UK. In the most ideal situation is if you have a view where you think the news on UK, for example, is positive and the news out of New Zealand is negative, then betting on the Pound Kiwi to the long side gives you the best of both worlds, because in a perfect world, if you're correct, one currency is going to decline, the other currency is going to rise, and that massive differential between the two is going to create these kind of huge movements of 300-400 points during the day. What's very interesting and very valuable about looking at this, at these ideas, is they're really off the beaten path. They're not what's commonly traded amongst the retail marketplace, but yet they offer some of the best trends, some of the best pure fundamental ideas of the day, and they allow you to avoid a lot of the noise that the dollar brings with them. And of course, this is what drives them on a day-to-day basis. So we've come to the end of my presentation. I've run over time. My apologies, but I think I really wanted to make sure that everybody got very, very detailed information about all of this, the commodity currencies, the Swiss franc, and understand exactly what drives each and every one of them. Let me just open up the floor to any kind of questions you guys may have. And also, again, reaffirm that everything is recorded, and I will be able to post this within the next hour or so, and I will send an email to everybody to show you where the webinar is located, along with the PDF for all of these information. So let me see if there's any questions now from any of you guys on any of the information that I showed you. Okay, well, thank you very much. I'm glad you guys enjoyed the tutorial. Let's just summarize. Before we go away, I sort of give you a very shorthand view of how you want to watch, how you want to think about these currencies. So Australian dollar, intrinsically tied to China, very, very tied to the commodity complex, and most importantly, within the commodity complex, tied to iron ore, steel, hard commodities, right? That's really the intrinsic thread that connects the Australian dollar, and that's how you're going to be watching it on a longer-term basis. The Canadian dollar is, of course, intrinsically tied to oil, so therefore oil prices are the single most important component of it. And the secondary component, this is the very big theme that we should be looking at, going forward for the next several years is trade. Trade. Remember, Canada is just basically, you can look at it as the 51st state of America, right? It's so intrinsically tied to America. And if there's any kind of change of trade terms between the United States and Canada and Mexico, that's going to have a big impact on Canada going forward as a big fundamental theme. New Zealand is a commodity currency, very, very small country, but incredibly lucrative and very, very active in the speculative market. That is also intrinsically tied to China, but on a soft commodity basis, where dairy and meat, its primary exports. And the thing about those exports is that they are repeatable, right? They're repeatable. We have a billion people who are going to buy milk every single day. And you can imagine if they buy more and more New Zealand milk, that provides just an endless stream of income to New Zealand. So therefore, New Zealand is better positioned than Australia on a longer term basis towards China. That's an important theme to remember as we think about commodity currencies. And last but not least, the Swiss franc, which is the gold standard of the currency market, which is effectively the last bastion of safe harbor, which carries a very negative interest rate, which actually penalizes people for buying it. They penalize people. It says, if you want to buy us, you're going to have to pay us money. That's how dear and valuable it is as a currency. And it's very prone to intervention also. And is really a trade if you believe the world is coming to an end. Right, that's its primary. Anytime we have these spasms in the financial markets when everybody thinks the world is coming to an end, that's when the Swiss franc is really going to shine as a particular trade. So hopefully this gives you a short summary of everything that I've taught you here today. I hope you guys really enjoyed it, and I'm glad you guys enjoyed it. Yes, the natural disasters like earthquakes that happen in New Zealand really actually are positive for New Zealand because they're always creating rebuilding, right? They're just always creating rebuilding. Remember, the critical thing about New Zealand economy is an income-generating economy. As long as it generates income from China, it's incredibly positive long-term for New Zealand, and that's the key thing to keep an eye on as we go forward. As long as they can sell stuff to China, they should be doing okay. And with that, I bid you guys adieu. Thank you very much for hanging out with me. I know I went over time, but I hope this was all really worth it. And as I said, everything is going to be recorded, and I will be happy to send this all out to you very, very soon. Everybody take care, and I will see you soon.